Let's take a look at understanding a balance sheet. Financial statements are the periodic report cards of how a business is doing from a monetary perspective. After all, money is the primary way in which a score is kept in the competitive arena of business. These important statements are a summary of a company's financial data compiled from business activity over a period of time. Typically, a company's accounting department prepares financial statements quarterly for the purpose of management review and government reporting of income tax information. At the end of the year, the accounting department prepares annual financial statements to present to the company's yearly financial position and their performance. Financial analysis is the assessment of a company's past, present, and anticipated future financial condition based on information found on the financial statements. Financial ratios are the primary tool of this analysis. These ratios are a way of standardizing financial data so that they can be compared with ratios from previous operating periods of the same firm or from other similar-sized firms in the same industry. Internally, owners and managers rely on this analysis to evaluate a company's financial strengths and weaknesses and help make sound business decisions. From outside the firm, creditors and investors use financial statements and ratios to determine a company's creditworthiness or investment potential. The balance sheet is the financial statement that lists the company's financial position on a certain date, usually at the end of a month, a quarter, or a year. To fully understand the balance sheet, we must first examine some basic accounting theory. Financial position refers to the economic resources owned by a company and the claims against those resources at a specific point in time. Equities is another term for claims. Keep in mind that a firm's economic resources must be equal to its equities. A business enterprise can therefore be pictured as an equation: economic resources equal equities. There are two types of equities: the rights of the creditors, those who are owed money by the business, and the rights of the owners. The rights of the creditors are known as liabilities and represent debts of the business. The rights of the owners are known as owner's equity. Owner's equity represents the resources invested in the business by the owners. Theoretically, owner's equity is what would be left over after all liabilities were paid to creditors. We can now enhance our equation: economic resources equals liabilities plus owner's equity. In accounting terminology, the economic resources owned by a business are known as assets. The equation now becomes assets equals liabilities plus owner's equity. This all-important equation is known as the accounting equation. The balance sheet is the visual presentation of this equation at one point in time. Some balance sheets display the assets on the left and the liabilities and owner's equity on the right. Another popular format lists the assets on the top and the liabilities and owner's equity below. Remember, on a balance sheet, the assets must be equal to the liabilities plus owner's equity.